we started off talking about the auction process. If the auctioneer has successfully completed the auction, price should drop away quickly from the highest price. Excess marks the end of one auction and the beginning of another auction. So on a short-term basis, we had an excess high on the French index. Then the market started to one time frame lower. Now, what do I mean by one time frame lower? The day 2 high did not take out the day 1 high. The day 3 high did not take out the day 2 high. The day 4 high did not take out the day 5 high, etc. The market is one time framing. Very important concept to identify if you have a short-term trend or any kind of trend going on in the marketplace. Now, we come down and the day on the far right is yesterday. It's Friday. Now, the broad stroke on the right-hand side of the top of the profile is where the market settled on Friday. Now, when I open on Monday, let's think of some of the possibilities. If I open on Monday and I start to trade higher, I have stopped one time framing lower. Additionally, I now have an excess low. Let's go back to the top. I had an excess high. Go back to the low. If we open higher on Monday, I have an excess low from Friday. The question is it going to be sustainable? This is what it looks like on a bar chart. Now, what I want to do, I want to take that same picture of this index, and I want to look at it on a market profile. I use the bar charts to speed read a market. I use the market profile, like putting the market under a magnifying glass, to be able to look at the market and give me depth. But we just had something else up there a minute ago. No. Okay, now move it this way. There we go. All right, now fill in the bottom portion. No, the yellow in from the midpoint. From the midpoint. Yes. Oh, that's right. Okay. Yes, snag. I use a tool called Snag, the screen capture program, and I'm going to show you very briefly how I do part of my research. What I do is I capture things and then I put labels on it so I can print it out. What I'm doing right here, and then let's show the upper distribution. Okay? As I look at the index, I see 2 separate distributions to Friday's market. I see a lower distribution, and then I see later in the day, I see an upper distribution. A bar chart would only give me a straight line. Now, I treat each distribution as a separate auction or as a separate day. If in fact I start to trade above the upper distribution on Monday, so I start to find acceptance over time, A period, B period, C period, I find acceptance above that level. What has happened? The market is no longer one time framing lower, right? Remember we saw the bars coming down. We talked about an excess low on Friday. One of the two most important concepts you will ever deal with is an excess low or high. Marks the end of one auction, the beginning of another auction. So if I start trading higher on Friday or on Monday, I've stopped one time framing, I've had an excess low, and I have reversed the short-term auction to the downside. We saw the auction coming down for 4 or 5 days. So my short-term auction was to the downside. If I trade higher on Monday, I have an excess low, I've reversed the short-term auction from down to up. Now, let's say that I open and I start trading in the lower distribution on Monday. If I start trading in the lower distribution, guess what? No real change. Trading is about change. Most of us don't like change. Can you imagine if the market didn't change, there'd be no opportunity? Traders should love change. So what I really want to know as I start to trade on Monday, I want to know if there's any change relative to this week, or relative to the week that we're currently in. If I start to find acceptance in the lower distribution, there's no change, right? My short-term auction is down, I'm getting continuation. So I have more of what I've been looking at. If in fact I start to trade in the upper distribution and above the high, I now have change. I have a lower I have an excess low, and I have reversed the short-term auction. Once I have some idea of what my short-term auction is, I now have a better orientation about the direction in which I want to trade the market. It's just a walk through a market that you can trade right here every day, okay? Let's take a look at, what's the next slide that we have up there? Okay, structure. Part of using the market profile is learning to understand what I mean by the term market structure. As you know, a bar chart is one-dimensional. You'll see a straight line. Once I go to a market profile, I start to get more depth and more structure because there's more dimensions to the market. The patterns that I see and learn to interpret, and the reason you use the market profile in the first place is to organize data the way scientists have done for years. Once you get the data organized, it is easier to understand and interpret. When I look at the pattern on the left, I have an excess low, and I don't expect you to understand all these patterns, from a very short introduction. I just want to give you some idea. When I look at that pattern, I have an excess low made early in the day, but then instead of the market elongating out, it kind of formed, there would be more, on the first, instead of elongating out, you see how it kind of looks like the letter P on top. What that tells me is that I'm looking at a market that is dealing with mostly short covering, or what I call old business. If I have a healthy market, I have a combination of short covering, and I have a combination of new money coming into the market on the buy side. That will more than likely give me a more elongated type of market, or a market that's got a better chance to go substantially higher. As I get a market that starts to truncate on the top, or form the letter P, that tells me that I had short covering, mostly old business, but it wasn't joined by new business, which is far more potent and much better opportunity to move higher. If you look at the center market, on the center market, you have an entirely different pattern. you have a market that opens on the high or opens near the high. And let's take a look. We talked about one time frame earlier, okay? A period. B period did not take out the A period high. C period did not take out the B period high. D period did not take out the C period high. Only down when I got to G period did I finally take out the previous high by 2 ticks. Generally, that will happen once in a trend day. But this trend is down on this market. So I'm getting the market. I had high confidence selling early in the morning. A period, B period, C period, D period. Selling, 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 selling. The market attempted to come into balance. The market attempted to come into balance. It couldn't hold that balance. And then the market broke down to the downside once again. Finally closing down near the low. Now, it's not perfectly clear, but when you get a market like this, that's fairly evident very many times when you have a higher low that is made early in the day, and the market doesn't even come close to coming back and taking out that higher low. The market trades in that direction for most of the day, and will generally spill that direction late in the day. Now, what I want to do, what's our next slide?
Structure.
All right, now, this slide shows me the structure, but also it allows me to see the volume that actually took place at each price. When I look at the high, remember when the auctioneer couldn't get anything started, and all of a sudden reached the price, in this case the price they said sell, at the B period high. Did price move away from that very quickly? 147 contracts. 5,000, 4,000. The sellers, it would be the innovators. The innovator, the early seller was there early. And as soon as that market up there, they were sell, sell, sell. When I see that, that is a pretty good reference for me for the rest of the day. Look down at the very low. Late in the day, they broke the market. And look at the closure. That's the low. Let's show the settle right up there. Look at the volume on the low 3 prints. Again, when we think of a market profile, it is a distribution curve, right? And the top of the curve, you want to see price above value. The bottom of the curve, most of the time we see price below value. Those are the indicators that you are looking for in there. And this is a rotational day, but the actual volume and the structure provide a tremendous amount of information when you're trading. In actuality, if you are trading this market throughout the day, you will see periods, as you get experience, you will see periods where all of a sudden you see the bids or the offers come in very strongly. They'll be in about a 3 or 4 tick range, and you just start to know the buyers or the sellers are there in an accumulation phase. Now, what I want to do, can we go to the S&Ps? And I want to look at, I want to look at 322. Okay, and split out M period. Now, I'm going to show you one pattern, but you will be surprised how often this pattern occurs. You know what a profile is. The blue line, or where it is the widest, reading from left to right, in the center of the range, is what we call, in my first book, Mind Over Market, we called it the point of control. I have changed that now, and the terminology I use now, I call it the fairest price at which business is being conducted today. And why am I calling it the fairest price? Because that's where the most volume took place. That's where it spent most of the time. If you then see in M period that the market tried to go down and take the low out, and you see markets do this all the time. When you are trading in M period down near the low for the day, are you trading at value, below value, or above value? If the fairest price is in the center, when you are trading down near the low, you are down there and you are now, people are selling the market short. The term we use, the slang term we use is selling short in the hole. Another way to say selling short in the hole means they're selling short at very poor prices, or they're selling short below value. This is what you call, this is how a short trap happens. So late in the day, they're trying to sell the market off. The fairest price to do business, they're selling it down here. Julia and I were out seeing Paris. We had no intention of trading, but because of the time difference, we came back to the hotel, we turned on the computer, and we happened to look, and the market was right down at that level. We said, interesting. It looks like an opportunity for a very short-term trade. The risk-reward was in our favor. Price was below value, and you see what the market did before the day was over. So about an hour later, the market has gone almost all the way back up to the high for the day. All that happened in there was that the shorts got caught. So much trading in the short time frame is nothing more than short-term traders getting too long or too short, and you get this constant inventory readjustment throughout the day. And in this day and age, there are so many short-term traders that everybody runs in one direction till they get in trouble, then they run in the other direction till they get in trouble. And we see